Hey everyone, Dave Keller here with Market Misbehavior. This week we've seen the S&P break below the crucial 4,200 level. So what's next? We'll look out below. We'll talk about 3 potential downside targets for the S&P 500. So last month in September, we actually put out a video called the Head and Shoulders Top, talking about this rotation to the downside and the risk of further deterioration. Now, as we get to late October, those fears have been realized with the S&P unable to hold 4,300, 4,250, and now breaking below 4,200 this week. That is also bringing the S&P below its 200-day moving average, below trendline support, and all those levels of support where we expected stocks may bottom out haven't held. So now we have to start thinking about potential further downside targets. How do you figure out what's next? In today's video, we'll look at the chart of the S&P 500, talk about some potential downside targets, how we can derive them, and how we can think about market action between now and then. Before we get to my chart of the S&P 500, here's one more thing I wanted to tell you about. Today's video is brought to you by Seeking Alpha. I'm a big fan of places that allow you to better understand the market environment. I think seekingalpha.com is certainly one of those. When you go to the website, I would check out the stock screener, particularly because it allows you to use Seeking Alpha's proprietary quant model. In my experience working with institutional investors, we always had what's called an alpha model, or a quantitative model, which really modeled the characteristics of strong companies, demonstrating strong growth prospects and strong price momentum. Seeking Alpha does a really good job of taking that institutional level quantitative capability and putting it in the hands of individual investors. If you go to marketmisbehavior.com/seeking alpha, or just click on the link in the description below, you can go right to a special offer. If you use the link, you get $50 off your first year and also get a 7-day free trial to check everything out. So go to marketmisbehavior.com/seeking alpha. Now back to the video. All right, so here's my chart of the S&P 500, and before we get to the levels, as a reminder, it helps me a lot if you like the video, if you subscribe to my channel. Can't tell you how much we appreciate that support. Also, drop a comment below. What is your downside target for the S&P 500 and why? I would love to know, so don't forget to drop a comment and give me your downside target. Here are 3 ways I think you can come up with it. So first, in that previous video, and again, there's a link in the description to that video where we talked about that head and shoulders top and all the things we would need to see in terms of a clearly defined neckline, a break below the neckline, often a retest of that neckline, and then a follow through to the downside. And one by one, all of those things that we listed off have been checked off. Now we have a market really in full distribution mode, and this week with a lot of the big technology and Magnificent 7 earnings coming out, underwhelming in terms of their outlook for the future, and certainly putting a lot of downside pressure on our growth-oriented benchmark. So once we've broken a key level of support, and this purple shaded area, by the way, is that area of support we were talking about. It coincides with a couple different, or I guess comprises a couple different levels, and it's really 4,180 to around 4,200. There are 3 reasons why this purple shaded area was the level of support that we were looking at, and I would argue why we've seen so much of a bounce off of those levels here in the last couple weeks. First off, it is the 4,200 is the February 2023 high, right? So when we rallied to 4,200, it took about 4 months to finally get through that level. And look at how many times we retested that level of resistance. Anytime you test a level, the more you test it, arguably, the more you validate the importance of that level, the more the market is telling you this is an important level, and when we finally do break it, it's meaningful. And so that's why that breakout, the end of May, early June, was really something to pay attention to. Second reason why this area is pretty important is because of the 200-day moving average. Of course, sloping higher over the last 6 months because the trend overall has been positive, but as prices deteriorated, the 200-day moving average usually continues to slope higher. It was ending right around that 4,200 to 4,220 level. It's currently around 4,240. Breaking down through the 200-day is pretty important. There's a famous Paul Tudor Jones quote: "Nothing good happens below the 200-day moving average." And again, not that it's the most perfect trading system I could ever come up with, but as a general rule of thumb, owning things that are above the 200-day and not owning things or leaning away from things that are below their 200-day is usually a way to participate in the bulk of the up moves and be out of the bulk of the down moves. And that overall is what momentum investing is really in some ways all about. So now that we've broken that, then the third item would be the 38.2% retracement level. This is a Fibonacci level. So if you take the October 2022 low, the July 2023 high, 38.2% of the way down is around 4180, and we just broke through that level. And that was one of those last levels. As we sold off over the last 2 weeks, we sort of talked about that 4180 level, that first Fibonacci level. Can we hold it? As of today, we appear to be breaking down there. So as always, you're following the trends to validate that there's further downside. But let's assume that this market continues to show a pattern of lower highs and lower lows. What happens next? So this is where we need to think about further downside objectives. 3 levels I would share with you: 4050, 3900, and 3800. And I'll tell you why each one of those is pretty meaningful. 4050 is reasonable for is important for 2 reasons. Number one, just like we talked about the 38.2% retracement level around 4180, the 50% retracement, which is often considered an important level with some methodologies, is right around 4050. You can see that orange horizontal line here. So that's also that blue shaded area I have to just sort of show where we're at relative to that potential area of support. Now you'll see this little line here that says 6%. What that is actually doing is it's measuring the height of the head and shoulders pattern. If you go back to that video and link in the description to the video where we talked about this head and shoulders pattern, basically once you validate the breakdown, once you break the neckline, which we did in mid-September, the way you measure the minimum downside objective is by taking the height of that pattern. And then once you break down, you subtract the height of the pattern from the breakdown level, from the neckline. So if you take that measurement, it's about a 6% range from the the top of the head to the neckline. Project that from the breakdown level, that gets you a downside objective of around 4080. So this blue shaded area is kind of around 4050 to 4080, includes those 2 levels, the objective based on the head and shoulders top, and also the 50% retracement level. If that level were to not hold, I would look down to around 3920. I said 3900 because honestly, I feel like if you have precise levels in mind, that's implying a precision to some of these measurements that I don't think is fair. I think in 2023, given the market structure, given dark pools and high frequency trading and all sub-penny spreads and all of that, I don't think it's reasonable to expect a precise decimal point as being an objective. So I tend to think a little more generally, and I tend to think in terms of support and resistance ranges. You'll notice that most of these levels are not horizontal lines, and I say the moment it hits this, you need to buy or sell. It's more about a range, and I use the rectangles on StockCharts to sort of demonstrate those support and resistance ranges. I think that's a healthy way to think about support and resistance levels, and then just understand that markets often overshoot or undershoot the precise level that you might come up with a measurement technique of some sort. So it's around 3920, and that would be a really important, arguably the most important Fibonacci retracement level. That would be a 61.8% retracement of the way back down from the July 23 high to the October 22 low. And so pretty reasonable to expect that as a good downside target if we continue lower. Let's say that wouldn't hold. I would immediately be looking down at 3,800. Now, that would be pretty dire if we would get there. That's another 300 plus points below where we're at here on October 26. But it's possible if you continue to see deterioration. The reason why 3,800 is important, a couple reasons. Number one, it's the March 23 low. It's the December 22 low. So after that first big move higher off of the October low, we pulled back to this point right around 3,800. We then retested that low in March, and then it was sort of off to the races into late July. Retracing all the way back down to that point, you could argue would be a great potential setup for a rally phase going forward once investors started to find value in buying in on weakness. The other reason why that level is pretty meaningful as I go to another chart is because that's actually one of the Fibonacci levels as well on a longer term time frame. Now, this is a chart I haven't showed in a little while, but and it's a little busy, but if you look at, let's see, the March 2020 low, this is the COVID low, and you go up to the December 21, January 2022 high around 4,800. 38.2% of the way, you might not be able to see, it's that pink line right there. It's right around 38.15. And so 38.2% retracing all the way down to the COVID low will be right around that same level, right around 3,800. And again, that lines up with the end of 22 and March of 23. So a couple different Fibonacci frameworks sort of key in on that 3,800 level. It's one we haven't talked about because there's been a lot that's happened since, but I wouldn't be surprised on the larger structure if we do continue to deteriorate, if some of those long-term levels become more important once again. So overall, to summarize, I would argue the market is in a distribution phase. The way I can say that is not an opinion, but more of a factual assessment of the evidence is because the market has gone from making higher highs to lower highs, from higher lows to lower lows, right? We're in a downswing of lower highs and lower lows over the last 3 months. Now that we've broken through a key support level around 4180 to 4220, what's next? I would be looking at 3 potential downside targets using Fibonacci retracements, using traditional support and resistance, and also just using simple analysis of the trends. 4050 would be the measurement based on the head and shoulders pattern and also the 50% Fibonacci level. 3920 will be that 61.8% Fibonacci retracement level. And then 3800 is more of a long-term level, but it's also where we found support. I often say, look at where we're at, look to the left, and see where we've been. And if you look to the left, pretty key, below 4050, that might be the most important level. The market is telling you to expect potential support. What do you see as the downside objective for the S&P 500? Don't forget to drop a comment and let me know the level and why. For Market Misbehavior, I'm Dave Keller. Be well, stay safe. We'll talk to you again soon.